Hi there, this is Sherri Eccles, broker associate with RE/MAX Bryan College Station, and this is everything you need to know about the changes in the national housing market for the month of October 2021. Calculated risk concludes that the annual growth rate of 19.7% is probably close to a peak, and that the year-over-year price increases will slow down as the year continues. Closings are set to decline at roughly 10% year-over-year in the second half of 2021. And home price appreciation is on the cusp of flipping to a decelerating trend. Again, there'll be an appreciation trend, just in a slower, more moderate pace performance rate compared to what we've been seeing in the previous months. This being said, prices are not necessarily declining. They're just appreciating slower and looking to appreciate 32% in the next 5 years. Buying now before prices continue to exceed expectations is important. Buying now is really mission critical. When we forecast the fourth quarter of the market with the pandemic being in place, fall is usually the start of the slower season, but we all know this has not been a normal year due to the circumstances. Potential buyers are seeing a slight rise in inventory while mortgage applications jumped over 7%, which is the highest level we've seen since April. It may seem like things are slowing down, but this is only because the last 2 years have not been normal at all. 2019 was the last normal year, and we are already doing exceptionally better in existing home sales in comparison. When will the listings peak? They can continue to grow. It could continue at the rate it's at, like it did in 2020, or fall. But there are 3 reasons professionals like myself think that listings will continue to increase throughout the fall and into the winter months. Number 1, there's a pent-up selling demand, and homeowners are starting to feel more comfortable with the idea of putting their home on the market since the pandemic is shifting and as more people are getting vaccinated. Therefore, having people into their homes for open houses or property tours is less of a potential risk. Number 2, new construction is taking place and starting to grow more rapidly, allowing more options for potential buyers and current homeowners to consider when they sell. There's no longer a lack of options compared to the options other sellers had in the past. And number 3, it's the end of the forbearance period, and it's creating some new listings. Don't worry, this will not lead to a wave of foreclosures, but it will allow homeowners to be able to sell their homes and have enough equity to more than cover the expense of actually selling. As far as interest rates are concerned, it's possible that in the next year we could bring prices down, and that may result in further economic, financial, and confidence challenges to also drop. Even with solid buyers in place, these drops or flattenings are nothing to concern ourselves with, as will not come close in comparison to the crash we saw during the Great Recession. Freddie Mac shows there's a 3.01% rise in mortgage rates, and many factors lead to this increase. The economy is recovering, not as quickly as we would like, but it's slowly making a comeback. There will be no sharp spike in a rise of prices, just a gradual growth inching back up, making interest rates rise a bit. The buyer purchasing power will cost more, and financing will be harder as the rates also rise. I'm your community market leader, Sherri Eccles, a helping hand for a happy home.